My name is Jerry Sanchez, and on behalf of the Multifamily Live group, Mark Weissy will be hosting this, and I'll pass it off to him.
Yeah, thanks, Jerry. Really exciting. We've got some really great speakers, some personal friends, Brian Alfaro and Cody Laughlin from Blue Oak Capital, which is a Texas-based real estate investing firm. They're dedicated to partnering with savvy investors to acquire cash flow producing commercial real estate. With over 15 years of combined real estate investing experience, the managing partners at Blue Oak Capital have invested in over 800 units as general partners, as well as over 2,000 units as LPs by way of 10 different apartment communities across the US. So with that, I want to give the floor to Brian and Cody, who are going to talk to us about the supply and demand imbalance in real estate and what that means for us as investors.
Well, thanks, Mark and Jerry. We appreciate you guys having us on. And it's always a pleasure to come, most importantly, network and just meet people from all over that, are outside of our region. So we appreciate the opportunity to be here. So, Brian, you want to say hello, Brian?
No, I was echo the same sentiments. I'm really excited to present with everybody today and look forward to networking and very thankful of the opportunity. I think we connected with Mark and Gonzalo maybe late last year, if I'm not mistaken. So definitely been building this relationship and we're looking forward to the opportunity.
Yep, absolutely. Absolutely. Well, guys, we're looking forward to tonight's conversation and presentation again. And I think this is a very relevant topic. And I think one, obviously, that is appealing to everybody because we're all feeling an immense pressure in the real estate world, whether you're trying to buy residential or commercial real estate. It's just an absolute, feeding frenzy out there, so to speak. And so we're going to talk about, how the current supply and demand dislocation really impacts us as commercial real estate investors. And so I'm going to go ahead and share my screen here if it's all right with you guys. And awesome. All right, guys, can you see that?
Yes, sir.
Awesome. Good deal. Well, let's go ahead and jump right in here. So before we do, Mark, thank you for the introduction. As he mentioned, we're a Houston-based private equity firm. We are focused exclusively on existing cash flow producing multifamily real estate, mostly across Central Texas, but we are partnered with other, high quality operators outside of our markets. Our core thesis is really about people first in everything we do, whether that's in the residents that we serve or the investing partners that partner with us. We're all about giving back to the people that we serve. And so, you can see here our mission statement: people first communities, investor first performance. And, we really lean in heavily on that core thesis. So to go a little bit more detail about us individually, I'll kick it over to Brian first and let him tell a little bit more about his story.
Absolutely. Thanks, Cody. So my background is actually not in real estate. So I have a different business that I also do along with multifamily real estate. I actually own a couple of coffee shops, which is a little bit different than commercial multifamily, but it's definitely an exciting business to be in as well. But I got into real estate in 2018 when I was in my late 20s, and I was really looking for opportunities to not only build wealth financially, but also to create that time freedom that we all want. Even though I wasn't necessarily working a traditional W-2, like a lot of people, being a small business owner is still very time consuming. It takes up a lot of mental space, and wanted to be able to long-term essentially retire early. I didn't want to be working until I was 65 at some corporate job or whatever. Not that there's anything wrong with that, but it just didn't match what I was looking to accomplish. So started in single family real estate and very quickly realized after, I'm sure Mark and some of these other guys can attest to it, it's a whole lot of work and it doesn't have enough zeros at the end of the checks is what I like to tell people. Has a really low ROE. It's a lot of work and it's really hard to do on your own. And the pie isn't big enough to share, unfortunately, for a lot of the deals. Nobody wants to split $200 or $300 in cash flow per month. So early 2020, right around the time COVID hit, I switched over to transitioned over to focusing exclusively on multifamily. I was very fortunate enough to meet John, our third partner, who can't join us tonight, at another multifamily boot camp to get educated, and eventually ended up joining a mentorship program in which Cody and John were already a part of. And I guess you can say the rest is history. Cody and John felt like I was a good fit to join Blue Oak, and added a skill set that they really needed to grow their business, and came in and we hit the ground running, started building our database and looking for that first opportunity. And we've had a pretty good year. That's all. I'll leave it at that.
It was three dudes with beards. What could go wrong? Yeah, Brian, you're absolutely right. We're fortunate to have connected with you last year and just put the pieces together to this amazing puzzle. And man, it's been off to the races since. So, my background, very similar to Brian. I started in the residential space back in 2010 by way of becoming an accidental landlord. After reading the Rich Dad, Poor Dad, Purple Bible, as I like to call it, all the light bulbs went off for me and, really switched my focus from focusing on escalating the career ladder in the corporate world to actually transitioning to becoming a real estate entrepreneur. And, spent the better part of the last decade in the residential space doing a variety of different strategies. And, very similar to you, Brian, just found that to be a very hard model to scale and not really suited for my investing goals, and made the transition to multifamily back in early 2019, and was fortunate enough to meet our third partner, John, at the end of 2019 and align with him and really launch Blue Oak Capital and set the framework for what our business is now. And then again, along comes Brian, and just it's just been an amazing growth since then. And so in respect to our partner, John, John is a project manager for a large oil company based here in Houston. And John is a very active passive investor, or has been since about 2015. And, once aligning, he's been a part of our team and been very active along with this. And so that's us at the Blue Oak Capital team. So, all right, guys, with that. So I'm a big MMA fan. So I use this reference here and this picture to really kind of represent what we're seeing out in the investing world right now. Anybody trying to buy any type of residential or commercial real estate knows that it's an absolute dogfight out there right now, right? I mean, if you tried selling your home, you're getting probably numerous amount of offers. My wife and I, we sold our home earlier this summer, and we had like 30 plus showings in a matter of 2 weeks, right? And then you go into bidding wars, but then you try to get into another home, and you're in that same mix. You're one of the 30 offers trying to compete on home buys. And even the rental market, I mean, you're getting into best in finals, believe it or not, for residential rents. And so you talk, and then in the commercial space, I think we were talking about this offline a little bit earlier. We, in all of the major markets, you're seeing an extreme amount of competition, 30 offers on every deal, 12, 15 people in the best and final rounds, right, Brian? And so there's just an immense amount of competition in the marketplace right now. So today's presentation is really going to be kind of debunking this idea of this potential housing bubble or looming correction that we may be in. So what do you think, Brian? Do you have anything to add to that before we go on?
Yeah, I mean, I think we're all feeling it. You hit the nail on the head. I don't think it matters what asset class you're in. I've got some single family stuff that I'm disposing of and some stuff that I picked up, and it's definitely very competitive. And, you hear from a lot of investors that they're waiting for, the correction, or, I guess, yeah, it fits perfectly with this slide, right? This is 2005, 2007, all over again. We're at the top. It's about to pop. And, a lot of people are saying we're in a housing bubble, but I think it's important that we really look back on what happened in 2008 and realize what sort of caused that to happen. And what happened back then is not at all what's happening right now. So for anybody who's been standing on the sidelines, sort of waiting for that, feel like they've seen this movie before, they know the ending, for that to happen, it hasn't happened for a variety of reasons.
Yeah, I mean, think back. I mean, people have been calling for the peak of the market since what, 2018, call it?
19, yeah.
And so you have a lot of guys that have been sitting on the sideline, but, and I think rightfully so, right? I mean, you have a lot of investors that really were devastated during the 2007 crash. You had people losing homes, losing their fortune, really being in a financial burden that took a while to recover, sometimes, circumstances that didn't recover. And so I think it's easy to point to the last recession and point to this one in comparison and say, oh, the end is near. But again, we're going to spend the next about 20 minutes or so kind of really debunking that and why we feel like, that's not such much the case. And, let's really start with the numbers in particular. And we're really in a housing crisis, guys. I mean, there is a significant shortage of available housing units across the United States. And you can see here for reference, as of the end of 2020, 3.8 million units are needed to not only meet the demand, but hit a particular target vacancy across the United States, which, is just unheard of. I mean, think about that, 3.8 million homes, whether it be residential or commercial, that's needed to supply to the current housing demand. And so that housing deficit has increased by over 50%. And so we call this the Great Dislocation because, that's a staggering number when you talk about the amount of homes that you would need to be able to produce to even close that gap. I mean, a housing deficit of over 50% is significant. And you can see this graph below here that kind of represents the overall aggregate decline in new home construction over the past several years. And you can see this is a trend that has really been downtrending since the late 80s. I mean, if you look at the aggregate again, this has been a slow, steady decline. And then you take the Great Recession and that decrease, from that impact. And we have not been able to keep up since. And we aren't even close to making that momentum to even gain or reduce that spread. So, this is a significant housing crisis that we remain in that is going to take some time to even be addressed.
Yeah, I mean, it's simple. I mean, as real estate investors, we often overcomplicate things. We were at a mastermind recently, and Grant Cardone showed up, and he said, "Y'all overanalyze everything." And it's Grant Cardone, so he's kind of a entertainment figure, so to speak. But at the end of the day, this is simple supply and demand balance, right? So we're going to talk a lot about some more details, but the amount of homes we're making has significantly dropped. The amount of homes that are needed has gone up based on generation. The largest, and this is going to be later on in the presentation, but the largest group of home buyers are now entering the market, right? The millennials, right? So there's an increase in demand for starter homes, which in, so to speak, theory are more affordable homes. And everybody knows that housing prices are going up and they're making less of them. So, simple math tells you that if there's not enough of something and there's a high demand of something, valuations are going to grow up. So that's kind of where we're at right now.
Absolutely. So the big question that everybody should be asking themselves right now is how did this happen? And why are we seeing such a rapid decline in the amount of homes being produced? And so, there's multiple factors that play into this scenario, and all of which, is no surprise. You have significant labor shortages that have existed even prior to COVID, but now even more so with the lack of qualified trade skillsmen that can go and, help in the contractor world. And so according to the Associated General Contractors of America, nearly 90%, and think about this, 90% of construction firms are faced with significant labor shortages. There's just not enough available hands out there for them to fill that void. And so what happens to that is it slows down production. It increases the amount of payroll costs. You have to pay skilled, qualified laborers, which ultimately translates into development costs. And so, that plays a significant impact. And I think, Brian, we were talking about the impact that you're seeing at your coffee shops, right? You want to speak to that real quick about what you're seeing as far as the labor shortages?
Yeah, wages are going up because nobody wants to come to work. It's kind of the short and sweet version of what's going on in jobs that are retail, restaurants, hospitalities, hotels, things of that nature that are really service related. A lot of people have not entered re-entered the workforce. I saw an article a few weeks, I believe it was at the end of September, early October, that said that retail is short. It might be the other way around, but retail is short 1.8 million. Hospitality restaurants are short 1.2 million workers in the US. And that was at the beginning of October. So call that 3 million people just short between the grocery stores you go to, the shops you buy stuff at, and the restaurants you eat. So that's caused a massive increase in wages. Here in Texas, minimum wage is $7.25, which is not the case in some states, but it's really hard for me to hire somebody for less than 12 or 13 bucks an hour to do the same job that they were doing prior to COVID for $9 or $10 an hour. So we're seeing this all around the US where wages are going up. And this isn't just in the coffee shops or hospitality, but when wages go up, what people fail to think about is, does it you might be making more money, but does it affect your purchasing power? And oftentimes it doesn't, because of inflation, right? We've all been reading the stories about inflation and prices going up. So even though you're making more money, everything's more expensive, and that includes your rent.
Yep, absolutely. So you couple your labor shortages with your rising costs, the cost of raw materials, right? And that obviously creates upward pressure on development costs. If you're having to build a building for more than what it cost you years ago, guess what? That has to translate into the overall valuation so you can afford those costs as a builder. And then you take into account, we have an aggregate decline in interest rates, and you can pull this up on multiple different sites, and you'll see a steady decline over the past century and more in overall interest rates. And if you exclude the hyperinflation state in the 80s, it's been a slow, steady decline. And all indicating factors would point to the fact that you have a better chance of moving more towards a zero interest rate or a negative interest rate versus actually going the opposite direction, and where you actually see a hyperinflationary state, which a lot of people are discussing at this time. So moving forward, the next obviously big impact that we've seen now is the COVID pandemic. And, no surprise here, we've seen just an incredible price surge again in some of those raw construction costs, and particularly soft lumber. I think, Brian, we were discussing this last week, right? Where I think at the peak, there was over a 1,400% increase in the linear foot per lumber, for example. And so if you think about how that translates into your development costs, it just plays a significant impact on not only your ability to mass produce development, but also produce those at an affordable cost. And so other raw materials, again, play into that. You have the increased labor costs, which we just covered, which puts more upward movement on that development cost. Historic lower interest rates, again, we just discussed. New migratory patterns. Brian, you alluded to this earlier, right? Where you have now employees that can now work remotely from areas that they would prefer to live in. That's not their office location, right? And so that's a really powerful thing right now, where you can work remotely from home and not have to go in and out of the office. That allows you a lot of flexibility to go live where you want, right?
Absolutely. I mean, this is something that nobody would have saw coming. The migratory patterns that we've seen last year and this year, and I'm curious to see the reports at the end of the year, have just been astounding, right? There's some really important multifamily figures that are, calling it the decade of the tertiary coming up, where some of these markets that nobody would have ever thought about buying a deal in 18, 24 months ago are now some of the more attractive real estate markets to go and chase yield, to go get that cash flow, because people have moved out to these more affordable areas of the US and have found that they want to stay there, and their employers are letting them stay there. So it's really changed the multifamily outlook, and a lot of other outlooks as well. But this is something that just can't be overlooked, is the migratory patterns.
Yep. And then we all know about the supply chain disruptions right now. I mean, there's a record number of shipping containers just sitting out of the West Coast, just waiting to be disseminated into the ports there, but they're anchored off. They can't get in. We don't have, laborers at the port. We don't have truck drivers to deliver those containers. And so it's just created this massive global supply chain interruption. And then we have impacts from China, lack of production there, and our global dependence on foreign trade, all playing a big factor into our ability to, again, mass produce development. And then, Brian, going back to your point again about the shift in the demographic, right? You now have a new transition of the largest demographic in the United States, which historically has been the baby boomer generation. But now, as that baby boomer generation continues to age, you now have the millennial generation, which typically is about the 25 to 40-year-olds that are now totaling 72 million in population, now seated as the largest demographic in the United States. Well, guess who's your first-time home buyers? It's the millennials, right? It's this age group of 25 to 40 that are looking to enter into first-time home ownership. And that's, again, driving that increased demand. So what's the result of that? We talked about a bunch of these very variable factors and how that creates an added upward pressure. And you can see that here. I mean, obviously what we've seen here is home prices dramatically increase by double digits year over year for the last few quarters. And then looking at the substantial impact over the past 2 decades, I mean, home values now are almost exceeding 60% higher than what we were 2 decades ago, which is, it's essentially forcing or pricing new home buyers out. And Brian, I know you're a residential real estate agent. You live and breathe this routinely. Talk about what you've seen from your perspective in the residential real estate market.
Yeah, what we've seen in the residential real estate market has definitely had an impact in the multifamily market, because a lot of people have went through the thought process of, man, it's a great time to sell my home. I'm going to sell my home. And Cody, you're one of these people. And then you end up finding out, oh crap, I don't have anywhere to go because I can't get another deal under contract, even if I wanted to. And now we're getting into even bidding wars on rentals, right? Cody, you had told me a story this year when you guys were in best and final on a rental. Like, that's just unheard of, that guys are competing against each other in the rental market. They're willing to put up 6-12 months, waive their deposit, make their deposit, go straight to the seller, whatever, non-refundable. So that's had a drastic impact in the rental market as well. There's very, very little single family rentals available that are affordable around just places like Houston, for example. If you want to live in a good suburb with a good school district, you better be ready to pay, and you better be ready to move quickly. So the home prices have affected that and moved into multifamily because a lot of people have just opted. Usually in some of these A-class products it's rent by choice, but a lot of people are becoming renters by necessity because they don't really have a choice. They either sold their home and can't find another one to live in, or, as Cody mentioned, we were talking about millennials a minute ago. They are the first-time home buyers, and they just can't afford a home anymore. They just don't make enough. They're getting priced out of the market. Texas is a great example. Everybody knows about what's going on here with Austin and Dallas and even Houston and San Antonio. A starter home is $320,000, $330,000, which may not sound a lot if you're from the East Coast or the West Coast, but for reference, 3 years ago, I mean, my wife and I bought our first home for right over 200,000, 220 or something like that, right? Just a 4-bedroom, 2-bath, single story. With good square footage, but just for some contrast, there's been massive appreciation just in 3 years, give or take, and what it costs to buy a starter home. So it's definitely had an overall impact on the real estate market, and it's going to be interesting to see where this continues to go.
Yep, absolutely. Now think about what happened last year during the pandemic, right? We had so many people that were left unemployed or furloughed. And, there was a staggering number, 14% unemployment near its peak, and just a substantial amount of people out of work. And actually, for the first time since the early 2000s, we actually saw a decrease in wages through the COVID pandemic. And you can see here represented, in 2020, the household median income was about $67,000, which is about a 3% decrease from the year prior. And obviously now we're starting to see that shift, and because of the inflationary pressures and because of the fact that, people have been relying on these government fiscal policies to support them, nobody's wanting to go back to work unless it's at a higher wage. And you're starting now to see that creep up. But that dip and that impact has definitely played its toll, again, on the ability for new home buyers to go in and actually enter into the residential market. And then if you think about your average spend on housing, the average American spends roughly about 1/3 of their income on housing. And so if you look at where that massive appreciation in home valuations are now climbing to, and we have a lagging household median income, again, it's pricing new buyers out essentially. And so that definitely plays an impact. And so moving on to everybody's favorite topic right now is the inflationary pressure. US inflation is no secret. It's at its peak since the, early 2000s. And so, we're seeing at the peak of September, 5.4%. And so we're seeing an insurmountable amount of inflationary pressure. And ultimately, most of that is coming from what we're seeing now: cost of shelter, cost of housing. And so that plays a significant impact in what we're seeing in, again, those valuations, right, Brian?
Absolutely. And let's be realistic here. Inflation's much higher than 5.4%. when you go to the grocery store, when you go to some of these other places, the gas station, prices are up way higher than 5%. Real estate is up way higher than 5%. We've seen 7, 8, 9% rent growth here in Houston, right? So these inflationary pressures, nobody knows when it's going to stop. At first it was transitory. Now they're sort of changing their tune on what it might or might not be. But inflation is definitely here to stay, and it's definitely having an upward impact or positive impact on rents if you're a landlord.
Yeah, absolutely right. We've been seeing a skyrocket in rental prices, and so not only the skyrocketing in rental prices, but you're seeing this massive wave of absorption in markets that historically may have not had as strong as absorption. And as people are getting priced out of the market, they're becoming renters by necessity, and some renters by leisure. You're now seeing the absorption rate exponentially higher than what it was, back in the early, let's say 2010 decade, where on average you're seeing about 250,000 units per year being absorbed. But now in just Q3 of this year alone, according to RealPage, you can see that over nearly 600,000 units so far have been fully absorbed. And we still have almost a full quarter to go. Well, now about a half quarter to go. But nonetheless, you could see that just this massive demand for housing, which is positively impacting us as residential and, investment real estate owners, and then, you can see here coinciding with that, with absorption becomes lower apartment vacancies. And so historically, the national average for apartment vacancies are, I think, around 90%, 92%. But now look at this, the average vacancy across the United States is only 4%. And, what's now leading to rapid absorption rates, lower vacancies, again, higher demand. You're seeing that double-digit in rent inflation that's been carrying throughout each year. I mean, you could see here median asking rent across the nation is now nearing $1,600 a month. And so that is playing a significant impact on us as apartment owners. And we'll get into that in a little bit later. So, Brian, any other additional comments?
No. I mean, this is why everybody is so bullish on multifamily. I hate to say it doesn't matter what market you're in. That's not true, but we're seeing rent increases across the US and in most major metros. I'll just leave it at that. And this is why the asset class has been so attractive. I mean, there's not enough houses, and we're seeing inflation and rents are going up, right? So this is something that we believe we're very bullish on personally, especially in some of the landlord friendly states that we invest in. Houston is a great example, the state that we're in, and one of our target markets. The average rental rate here in Houston is right over $1,200. So when you compare it to the national average of being over $1,500, there's a lot of room to grow. And a lot of people that still bought properties 2-3 years ago that pushed rents and thought they wouldn't be able to push them anymore, are seeing just still, staggering rent growth. So this is the prime reason, multifamily is so attractive. It's hard to build. It's expensive to build compared to what it was 2-3 years ago, and rents are going up.
Absolutely. So the question is this across every market across the United States? We all know every market's different, right? And every market's going to have its own demographic and its own population and such. And so, but one easy measure of determining whether your market's better suited for renters versus home buyers is looking at the rent price ratio. And the price to rent ratio is basically just an indicator on whether, again, the affordability of your market, and so, based on a numerical scale, a price to rent ratio of 1 to 15 would normally indicate that a market is better suited for a buyer than a renter. Maybe the affordability gap is much lower, but a price to rent ratio of maybe 16 to 20 indicates that, it might be more of a favorable for a renter's market than a buyer. But then you go above 21, which is really leaning heavily into it being a more affordable to rent versus buying. And so let's look at a quick example of what that looks like. And so, Brian, you mentioned this a minute ago, right? So if you look at the formula, very simple formula, if you take your median home price in your market, and you divide that by the median annual rent, that'll give you that numerical value. So take Houston, for example, where the average average median home price in Houston is roughly around $335,000. But the average rental income or rent speaking of dollars, man, we've been talking about deals all day, so you have to forgive me, guys. But the average rent across Houston is, like Brian said, $1,200 a month, which equates to be about $14,000 per year. So if you divide that and you do that figure, that's a price to rent ratio of 23. So if you look back at the previous graph that we just mentioned, 23 indicates that it's more affordable to be a renter in this market than it is to be a home buyer. So as a real estate investor and as an apartment owner, does that look favorable to you? Absolutely. And it's important to know, I get this. Sorry, Brian, this price rent ratio, guys, this is very market specific. So, I would challenge all of you, go back to your markets, your target markets, and factor this in and see where your markets are lining out to be.
Yeah, this is not very complicated. The question becomes, is in the market you're targeting, is it more affordable to buy a house than it is to rent? You don't want to be in a market where it's easy to buy a house. Like if you're buying, somewhere here in the tertiary market in Texas, and you can buy a little starter home for $150,000, $200,000, but the rents are, call it $1,000 a month. It doesn't make sense for you to own an apartment complex there. The correlation doesn't make sense, right? But we're talking about Houston a lot, but in our market, for example, I sold a starter home, so to speak, a little 4-bedroom, 2-bath house recently, and after all taxes and insurance, their mortgage was almost $2,300. Right. And they bought it for right around $320 with a 10% down payment, give or take. Because as we go up in price, a lot of people don't have $75,000 sitting around for, 20% down plus closing costs on a $320,000, $330,000 house. So they put 10% down. Their mortgage is $2,400 a month. Now, Cody and I are looking at some A-class properties here in Houston where a 2-bedroom, 2-bath is currently at high 1300s, high 1400s, with a lot of room to grow into the 1500s, if not up, right? So when you see a $1,500 a month in an A-class property or $2,300 a month to own your home, that's a very large delta. A lot of people can't pay that $700, $800, $900 difference between owning and renting. So that's why the price to rent ratio shows you here. In our market, it's a very good example of why it's actually more affordable if that's what your primary goal is, to actually rent.
Absolutely. So what does all this lead up to, right? This has been the thesis of this presentation, is how does all of these variables impact the commercial real estate market? And so if you look here, you can see, just a plethora of different impacts. And so, if you consider just the overall increase in demand across the space, again, we've talked about that ad nauseum so far. We've seen a record amount of velocity in the multifamily sector, right? And so $53 billion worth of transactions so far, just in Q2 alone this year, record-setting number of velocity in this year alone. And so the demand for the product type has just exponentially increased. And one other thing to note is, if you think about what happened during the COVID pandemic, the government put into the economy stimulus packages. They put in PPP loans for business owners. They put in fiscal policy for, renters and homeowners to be able to stay in their homes. And so if you think about those layers of protection to ensure that millions of people weren't being put out on the street, there's no other asset class that the government had backed so strongly to make sure that it stays afloat and stays supported, and that people stay in their homes and in their apartment communities particularly. And so that's important. And to have that backing, that gives you as an investor a lot of security when it comes to the reliability of the asset class. We talked about the advantage of the low interest rate environment and the low cost of debt right now, which is, again, fueling a lot of those valuations. And so now investors are coming in and they're able to pay more per door for these properties because their cost of debt is so cheap. And then you look at the overall prices that have, again, we've appreciated exponentially from Q2 last year to Q2 of this year. I mean, a 12% increase in valuations in on apartment buildings with no value add. Okay, with no forced valuation increases. It's just all organic appreciation. All of that's driving this massive demand for the product type.
And this is the next one. Ahmed had a question, Cody, but I think you're about to hit this. He wants us to elaborate on institutional money flooding into the market, taking up opportunities that are arguably with a little meat on the bone.
Yeah, I mean, it's a perfect segue, right? You got guys like Blackstone, who else is it? Greystar. I mean, all of these massive institutional buyers that now are allocating billions upon billions into their affordable housing portfolio, right? Because they see this significant supply shortage. And so, you do have the institutional buyers that are now coming into markets where historically they would not be in. They're now loosening their buying criteria because they're looking to place capital into the secure asset class. And so they have to move that massive amount of liquidity now that's just sloshing around in the marketplace. And so we're seeing them in tertiary markets. You're seeing them in workforce housing spaces. And so, their appetite for this product across all asset classes is definitely there now. And so,
and I think you have to remember that the institutional buyer is looking for something very different than what Cody and I, and maybe even what you were looking for. You said meat on the bone. Well, meat on the bone is subjective, right? So meat on the bone for you is different than meat on the bone for me, which is different than meat on the bone for Blackstone or any of these other companies. They don't care about cash flow necessarily, right? Which sounds crazy. Like, why would you ever invest in real estate and not care about cash flow? Well, a lot of these guys don't, because they know that the market's going to appreciate, like we have been seeing, especially when you're buying these attractive, even workforce housing products that you can't make anymore. People think it's like crazy that people are buying C-class products here in Houston for 120, 130 a door. Well, when you go build it, it's 250 a door, right? So that's simple math for Blackstone to go, I'm going to go buy that at 130, 140 a door and bid up the price, where we're looking at it going, that doesn't work. You're getting like a 4% cash on cash. Well, that's totally fine for Blackstone, because guess what? They got a pile of money. They need to put it to work. And if it gets a 2, 3, 4% return, that doesn't matter to them, because that money is better off there, which is a hedge against inflation, and it's appreciating, than it is sitting in some account in some other asset class like office space. We've seen a lot of money move from there as well.
Yeah, absolutely. And so what do you see with that demand, right? You're seeing this massive compression in cap rates, and across all asset classes, A, B, C space, it doesn't matter. Brian, to your example, we're buying, or you're at least underwriting deals, value add deals at a 4 cap on a C-class product, and which is absolutely absurd, but that's the market now. You're now seeing that massive compression. And there's even people like ourselves that believe we're going to continue to see further cap rate compression as more demand continues to enter into space. Now, one thing to note, one thing that we do have to be cognizant of is, as we're seeing this increased demand and these lower compressed cap rates, what are you seeing happening to returns? Well, they're diminishing. The idea of double-digit returns is really dissipating. It's very rare that you're seeing these opportunities now. And so, your average mid to high single-digit returns are now considered a decent, favorable return in today's marketplace. And so, and it's because of the more long-term favorable outlook within the multifamily sector. And so, really to kind of sum this up in very simple terms, you have higher input costs, you have significant housing shortages, you have a significant lag in overall wages and the availability of workers in the market, that are all driving this massive upward pressure in these valuations. And so what does that really equate to? What should we be doing right now, Brian?
I think we should buy everything we can see.
You should buy every freaking thing you see. No, I mean, we're being facetious, but you should absolutely be in a buyer right now, guys. You should be buying everything that makes sense to you right now in this market cycle. This will, in my opinion, go down as probably one of the best block of years to buy investment real estate, because of the dislocation that you're seeing in the marketplace right now. So again, if you're on this video watching right now and you're thinking that this bubble is coming and you're sitting on the sideline, I'm going to make a prediction that you're going to be a very frustrated investor here over the next couple of years, sitting there lonely, wondering why you missed the boat. So, guys, these are variables that cannot be corrected in a short, reasonable period of time. So, be very, very active right now in buying in the real estate. So,
yeah, and we're not saying be irresponsible out there. We're doing our due diligence. We're talking to our lenders. We're talking to the brokers. We're talking to insurance. We're talking to tax consultants, and we're making sure that we're, underwriting deals very thoroughly. So don't, mistake us for saying buy and just go buy everything literally and throw it, any offer out there. But at the end of the day, Cody and I can speak to this firsthand from experience. There are deals at the end of 2020 that we thought we wanted, we liked, that we thought there's no way in hell. This is way too much money. There's no way these guys are going to get their asking price. It doesn't make sense. And those same deals are $30,000 or $40,000 more per door. Right. So, and again, we're looking at larger products. These are usually 100 plus units, C class, B class, and now even A class. And these things are trading at a significantly margin. So if you would have just bought it in sometime 2020, let's call it August, September, October last year, your property would already be significantly more valuable and you wouldn't have even had to do anything to it. Now, that's not going to continue forever. So you still want to be responsible. But back to Cody's point, don't be standing on the sidelines, be looking for deals, change the way you're thinking about things to make sure that you're not missing out on opportunities waiting for a crash, because you're going to miss the boat, in our opinion.
Yeah, Brian, and just I think to piggyback off, stay in tune with what's going on in the marketplace. Guys, there's data overload right now that's coming out daily as far as some of these metrics and KPIs that we've discussed. And so just stay in tune to the marketplace and pay attention to what's happening, because it's ever evolving, it's fast moving. We feel like the needle moves every week, right, Brian? And so, it's very important to stay in tune to the marketplace right now. So
yeah, know your market, right? That gives you confidence. It's not going out there and just throwing offers at random places. You know your market, be in tune with everything, and make educated decisions.
Absolutely. Absolutely. Well, guys, if you'd like to learn more information about the information contained within this presentation, here's our works cited page. You can see some of our resources here. Happy to share these offline if you need some additional resources. If you want to learn more about Brian and us and get checked in or in tune with what we've got going on, check out some of our thought leadership platforms here. We have a great podcast called the Prosperity Through Multifamily Real Estate Investing podcast. If you love networking, which all of you do, that's why you're here. Definitely make sure to come check us out, the South Texas Houston chapter of the Multifamily More community. We host both live and virtual events every month. And you can also learn more about us via our website, www.blueoakinvest.com. And Brian, we're visible everywhere across social media. We're not very hard to find there, especially across LinkedIn and Facebook. So if you'd like to connect with us directly, you can check us out at Cody or Brian at blueoakinvest.com. And again, find us on LinkedIn, and we'd love to connect with you there. And with that, we'll turn it back over to Mark.
Absolutely. Thanks, guys. That was awesome. I got to say, I'm a big believer in the supply-demand imbalance. Frankly, me coming from the financial markets world, I look at the opportunity here, and like you, I say that, there's no better asset class to be in. I think inflation and things like that capture a lot of the headlines. But as far as us as investors, inflation is really on our side. Rising wages mean that our renters are able to afford more. And ultimately, like you said, the fact that some people are on the sidelines and not able to get into the home buying realm means that we'll have a larger audience for a lot of our units. So I think all signs point to continued compression, just like you guys. But with that, we can open it up to the rest of the group here to see if anybody has any questions.
Let's scroll through the chat here.
You know what? I got a question. I can get it started here. How do you, in today's extremely competitive market, have you changed the way that you're underwriting deals? I know you mentioned, cap rate compression and, lower expected returns or lower required returns. Are you potentially maybe underwriting longer hold periods? Kind of maybe walk us through how you look at deals differently today than maybe 12, 24 months earlier.
Yeah, I'm gonna make a response. I'm gonna give you a response that may not be one that most people are gonna like, but it's the raw truth. If you're a conservative underwriter, you're a very unhappy underwriter right now, because if you want to give yourself any opportunity to go buy investment real estate right now, you can't afford the opportunity to be conservative. Now, that doesn't mean be irresponsible, but if you're just projecting a flat rent growth throughout your pro forma, or a very wide spread or margin on your reversion caps, for example, you're going to price yourself out without even being able to come close. And so to answer your question, has our underwriting practices changed? Absolutely. I mean, deals that I was underwriting, just 8 months ago would look drastically different now than what we were 8 months ago. And so, we are looking at what's happening real time in the markets. What type of rent growth are we seeing? What's the absorption rates in the markets to fuel that future rent growth, and how we can be creative in adding that value on the projects, looking at things like reducing the spread on our reversion caps. If you ask me again, a year ago, I would probably tell you at least 100 basis points on your reversion spread. Now we're looking at flat to maybe 30 basis points on your reversion. And, again, you have to identify what your thesis is. You may see the market very differently, and you may think that the crash is still around the corner, and you may not want to, and you may want to rely on that. And that's fine. Figure out what works for you and stick with your underwriting practices. But for us, that we believe, again, I think we're going to remain in this low interest rate environment. Demand is going to be there for the foreseeable future, for sure. I think that's only going to continue to further cap rate compression. You're still going to see inflationary pressure that's going to drive rents. And, the supply dislocation is not going to be resolved anytime soon. So the demand for the product is going to be there. So I think you have to make sure that your underwriting is in tune with that. So it's kind of a vaguer answer, but you got to be willing to get a little uncomfortable right now.
Mm-hmm.
Yeah, I'm just going to say that.
Yeah, you got to know your market is really what it's at, right? There's these rule of thumbs that a lot of the gurus and the programs and stuff on YouTube, they'll try to teach you, right? Like 3% rent growth, 2% expense growth, just kind of stuff like that. Well, in Houston, the rent growth this year is almost 8%. So if I'm underwriting deals at 3%, guess what? I'm losing every deal I submit an offer on. So you got to know your market and not be irresponsible. Don't take it to 20% to make the deal look amazing on paper, but each market is very different. And Cody and I are looking at some deals here where there's a $350 delta between units that are in place rents and potential. So on paper, you're looking at it in year one is like 9% rent growth. And if you are a conservative underwriter, you're going to go, no way, this is never going to work. But on paper, they're already proven that business plan. The current owner is already capturing the $350 delta. So why would you not underwrite to that? Right. So it goes back to knowing the market, sticking to your investing thesis and know what's good for you. And it's different too. I think it's different in the size of asset class you play in. That's important to note. Not everybody's syndicating, right? If you're buying your own deals, if you're buying 6 units, 8 units, 12 units, whatever, maybe you're doing these little JV deals, you can take different types of risk versus using other people's money. When you use other people's money and you're syndicating, we're raising millions of dollars, you have to look at things a little bit differently. So that's something to be considerate of as well. If I had all the money in the world, I'd be buying everything right now. I wouldn't care about cash flow. But that's because I know what I know. But not everybody has that same investing thesis.
Yeah. Now, going back to that though, listen, you always want to stress test your deals. You still need to put your deal through a rigorous stress test. And if you can make sense at whatever your underwriting is with a rigorous stress test, then that's the comfort level you have to figure out for yourself as what makes sense for you to buy, right? At what valuation. And I think as long as you can come to terms with that and you can stress test that and you get comfortable with that, then that's how you got a decent deal, And I think some hedges against that too. I mean, look at your leverage. It's just, this is basic real estate fundamentals. You don't go into your deals over leverage. You can weather a lot of storms. You can weather a mishap and things like that. So, the days of 100% that, no money down and these crazy leverage, you don't see that in today's marketplace. And that's, Brian, you were alluding to this earlier. That is a significant difference between the financial crisis that we went through versus now is the debt practices our lending practices are so much more sound, right? So, just be prudent in your assumptions on your debt side. As long as you don't go in over leveraged, you could weather a lot.
Yeah, I think
Absolutely.
They were selling multifamily deals in 2007, 2008 at like 10 and 15% down. Good luck getting one now below 20, 25%. So just to hit that point.
Yep.
So be prudent with your leverage, know your market, making sure you're underwriting, stress testing that underwriting, and don't be afraid to take action ultimately. I definitely agree that this is kind of going to be a long-term thing. I know that Gonzalo, my partner, who's also on this call, and I looked at a lot of the same data that you guys look at, that 3.8 million unit shortfall, the deficit there, that we need 3.8 million. That's a real number. Another number that we had come across was there are 4.6 million millennials every year that are turning age 33, which that's the prime home buying age. That means that equates to 1.9 million new households every year. So if you take just the millennial cohort, that's 1.9 million new houses or units that we need every year. Now, last year was the largest supply year for a decade, and we only produced 1.4 million. So that's almost a 500,000 unit gap just for 1 year. So not only do we have to make up for years prior, that 3.8 number, but also every year we have to kind of, close this gap here. So I agree with you guys. I don't see this turning around anytime soon unless there's some huge exogenous shock, to either supply or demand for housing. And I don't see how that would be the case.
You're absolutely right. And again, we mentioned it in the presentation, right? Guess what the big guys are doing? They're seeing the same data metrics that we are. And that's why you're seeing this massive transfer of liquidity into this asset class. And that's why you're seeing this massive demand. And so here's the thing that you have to be careful with, be sitting on the sideline or sitting idle right now, is there's a massive transfer of wealth. The bigger institutional players are going to continue to buy up investment real estate. They are going to buy any and everything they can get their hands on. And so, not to say that they're going to eliminate all of us as the retail investor, but it's going to become increasingly harder to get in these assets. And so you have to be active, and you have a competitive advantage as a retail investor where you can move with more swift promptness. Institutional buyers, they have to go through a buying process. They have to go through a vetting criteria. They have to go through multiple layers of approval to get to whatever. Now they have the liquidity, so there's security of closing. But if you have speed in your side, use it. But the point to that is again, success leaves clues. The big institutional buyers are gobbling up every piece of real estate they can, especially multifamily. There's a reason.
Yeah, and I agree on that point you made too, Cody, about the barrier to entry. I think it's going to keep getting harder and harder to get into multifamily. Just my personal opinion. It's just there's so many guys playing in the space now. There's new people moving into the multifamily space every single day. And that's not to say it's a bad thing, but back to your point about the institutional buyers, these prices are getting driven up. And, a syndication maybe 2-3 years ago on your first deal, maybe you were raising $500K or $1 million. Now that's a $2-3 million, and it's just gonna make it harder and harder, and the returns are gonna get pushed down. So now is the time. I always tell people, the best time to invest in real estate was yesterday. So if you're thinking about standing on the sidelines for another 2-3 years waiting for a crash, I think you're gonna find yourself in a situation where it's still possible, but your barrier to entry is gonna be even that much more higher. Time is not on your side.
Now, I don't see any other questions here. I've got an additional question. I don't mean to monopolize the Q&A here, but in terms of, you covered a lot of how we can better, align our expectations with what's out there in the market. Now, when you're going to make an offer today, are there certain practices that you all have adopted at Blue Oak to maybe make your offer stand out versus others? Or is it more or less the same way it's always been?
This is funny, Cody. I'll let Cody take this one.
Listen, one of our struggles, and look, we're in the same boat as everybody, guys. One of the struggles that we had, and we lost opportunities earlier this year because of our unwillingness to get uncomfortable. And what do I mean by that? Hard money, risk capital upfront, shorten escrow periods, shorten due diligence periods, all of the things that right now are driving terms and what the sellers want to see. They want a surety of close. What's the fastest path to equity, and what's my fastest date to close? You could, price and terms are right now driving the marketplace. So for us, we had to get out of our own comfort zone, and we had to realize that if we were going to be active in this space, not just going looking at deals, not just underwriting deals, not making offers, but if we were truly going to actively be buyers in this marketplace, guys, you have to put up risk capital. You're going to have to get comfortable with shortening your timelines to close. If you're presenting an offer with the same purchase price at a 60-day close, and I'm coming in and telling you I'm going to close in 30, guess who the deal is going to? It's going to the guy who can close in 30 days. So that's where we've gotten very aggressive on our terms. We're looking at very shortened due diligence periods. We're looking at, earnest money, 1%, 2%, 3% sometimes, hard money out the gate, and looking at those shortened escrow periods. Now, there's a certain contingency in exchange. If as a buyer, if I'm going to give you, seller, your purchase price, I'm going to request that it be on more favorable terms. So if I can get an early access period, for example, where the day that you pencil and you sign my LOI, I can go on site and perform our physical due diligence. So that way, by the time that PSA is executed and my money goes hard, I should be able to at least have most of the important due diligence items at least addressed and identified. Then that's definitely a practice that we adopt. And I think that's a common practice, knowing that people are being asked to put up so much risk capital. That's something that most sellers are being amenable to. But, it's definitely something that you want to look into for sure.
Yeah, and really competitive markets like ours are really eye-opening. I think, and every market's different, but Cody and I strategically try to align with very experienced operators. Most of the guys we try to do deal with have 2, 3, 4,000 units, if not more, just because we feel like there's a lot of value in there in getting their experience. And the stuff you hear them say that they're willing to do to get the deal done is just insane. We've had conversations with brokers that have seen guys go $1 million hard day one, straight to the seller, skip title company right into their pocket. Right? That's extremely aggressive. We were talking to our good friend who we're trying to align with, who says, just tell the seller you'll completely waive your due diligence period. And this is on a $30 million deal, because he has confidence. He's got 4,000 units. He's vertically integrated. He has confidence in his ability to execute due diligence and fix any problems that he finds, regardless of whether that happens. So some of these guys that are very experienced, that are 3, 4, 5, 6 years ahead of us, they're willing to risk a lot besides just the purchase price. So it just gives you a little bit of perspective. Not say that if you're just starting, you need to do that, but that's the type of competition you're up against.
Yep.
And it goes back to that barrier to entry thing. If you guys coming in, it's very rare that we have less than $200,000-$300,000 of hard money in our deal. If you got guys coming in putting 500 or $1 million, and guys willing to waive inspection periods or shorten them drastically, and to just basically give the seller what they want, and you're over here being, I'll use the term conservative, you're not even close. You're going to be missing out on every offer. And like Cody said 1 million times, you're just going to be very frustrated.
Yeah. And look, guys, for those of you who are listening, you're like, oh my God, where am I going to get $500,000 hard or $1 million hard, or where am I going to get this risk capital? The beautiful thing about this space is it's a team sport. And guys, there's plenty of investors out there that would be more than willing to put up risk capital to be involved in a GP. There's more than Brian, we have this problem. We have way too many KPs. We have way too many people that want to sign on $30, $40 million loans, right? Guys, the money's out there. Just go find it. Go figure out what your barrier is and go build your team around that barrier and eliminate it. And I promise you, there's investors out there. Just find the right alignment.
Yep. As real estate investors, your actual job title is you're a problem solver, right? Whether you're fixing, people like the term tenants and toilets, right? Whether you're dealing with that or you're dealing with some sort of challenge, you're just a problem solver. So if your barrier to getting a deal done is $300,000 of earnest money, well, don't let that stop you and go, well, guess I can't do real estate anymore because you don't have 300K. There's so many guys running around with 3, 4, 5 millions of dollars of capital. They want to put it to work. They want to go put earnest money down in exchange for a slice of equity. They want to put earnest money down for 90 days while it's tied up, and then you repay them through acquisition fee or find some sort of creative way to give them their money back. There's lots of money out there, like Cody said, and it's not, we always say it's not how, it's who. So go out there and just shake hands with the right people.
Absolutely.
Well said. Okay. It looks like there's a question here from Ahmed. Are you sponsoring your own deals?
Absolutely. Yeah, absolutely. And look, we're having the same challenge as everybody else. You're one of 20, 30 offers on every deal. And so, just to kind of be a broken record here, I mean, we're running into the same barriers that everybody else is, and the same level of competition. How do you distinguish yourself? And, we want to be very active buyers right now. I think, again, going back to the point, we want to buy as much investment real estate as we can over the next few years to position ourselves for what we're about to experience in this marketplace. So, Brian, you said it eloquently. We're all about strategic alignments, and listen, guys, there's so many opportunities out there. And one problem that you see often is everybody's bidding on the same things, but nobody's talking to each other, and we always tell people it's always better to work with people, not against each other. And so go build that strong team of people around you to do it. But I'm going off on a tangent now. Short answer, yes. Yeah, we're sponsoring our own deal. So
Hey, Brian, Cody, quick question for you. What other markets outside of Texas do you guys like, or are you potentially investing in, or are you just strictly concentrated there?
yeah, I mean, listen, I think with the amount of competition out that's in the marketplace right now, it doesn't make a lot of sense for us to go build a new footprint outside in other markets that already have, people present there and whatnot. So we like to align with people in our other markets. So we are aligning with, partners in South Carolina. We are partnered in a deal in Columbus, Ohio. So there are several other markets that we do like, and we just love partnering with good people that we like and we trust and that have good experience and that has a great team. And so if that's Florida, Carolinas, Columbus, Ohio, all of those markets we enjoy. But I think for our own active deal sourcing is coming mostly out of Texas. So, our thesis is like, look, we're not going to invest anywhere we're not willing to go travel to. So if we can get to it and we like it, then we'll invest there.
Fair enough. Okay. Well, I think that kind of brings us to the end here. We'll be conscious of both your time. Really appreciate having you both on. And for anybody that was on this call, as well as anybody that wasn't able to make a call, we'll make this recording available to everybody so you can replay it. There was just tons of information, tons of gems dropped, as we say. So thanks again, Brian and Cody, for taking the time to talk to us about where the market is and where you see it heading.
Well, thank you guys all so much for having us. It's been a pleasure and great to connect with everybody. And I hope you found some value out of it, and, look forward to connecting with all of you.
I echo the same sentiment. Please reach out, connect us. We love talking to other real estate investors, whether you're new, seasoned, active, or passive. We'd love to chat with you. Like Cody mentioned, we just want to, find ways to connect people and do good deals. So we'd love to talk to anybody else.
Yeah, these guys are awesome. And I'll just reiterate, they have a really awesome podcast, Prosperity Through Multifamily Investing. Did I get that right?
Yes, sir.
There you go. Okay. Yeah, they have some great guests on there. And obviously, both of them are operators, active operators in the space. So give them a subscribe and listen to a lot of the great content that they're putting out consistently.
Thank you, Mark. Appreciate that.
Thanks, Mark.
Absolutely. So